at IAS12 income taxes. So from the particular accounting standard name itself, you already can know that this standard we are actually explaining how are we going to account it for income taxes. So there are two parts in IAS12. First part will be calculate current year income tax. So meaning to say we will need to recognize current year income tax expense. So under this income tax expense, you will need to apply some basic knowledge that you learn in taxation papers. For example, if I'm given you net profit, you do know that because of the accounting's principle and the tax law is different, therefore there are certain things that you have minus to arrive in net profit is not allowable in under income tax. So you will need to do some adjustment. Plus back the fines example, because fine is disallowable under income tax. Maybe you have double deductions income tax expense, some expenses that you can double deduct, for example. And you might need to plus back your depreciations, because this depreciation is not for your tax, it's just for your accountings. And lastly, we will need to minus our capital allowance. So this is your tax depreciations, something like that. Example is 4,000. Then you are going to get the net amount. The net amount in income tax, maybe we will call it as adjusted income, but in here IAS12 we will call it as taxable profit. Then only we will apply with the tax rate, maybe the tax rate at 24%. So this gonna be the income tax expense, and you are going to make the necessary income tax double entry by debit income tax expense and credit your tax payable as liability. So this is what you are going to learn in your tax papers, and in IAS12 using the same logic, we will make a provisions for current year tax based on this double entry. So as you have heard it, the word that I used just now, I used the word provisions for income tax expense, or we accrued for the income tax expense. So this is just an estimations. This is just an tax estimations amount. The actual amount might be different. So if let's say now you were to draw an income tax expense account, so this is an income tax expense account, and you will need to debit here. So in year 1 you have an income tax expense debit, so this is tax payable, and you will need to credit your tax payable liability account. In year 1 as well, and this is tax expense, and you will credit this side. So this is year 1. So this is again is an estimations. So for instance, now we are trying to close our account. This is going to transfer to your SOPL. You will close the account because tax account you are going to report in SOPL. Then this particular year's account officially closed, and this is income tax for year 1. For tax payables, your credit liability here, you are going to awaiting for your actual tax payable or actual tax paid. So for instance, if I tell you actual tax paid is actually 24,000, so you are going to pay the tax, and when you pay the tax, you will need to debit tax payable, and you need to credit your bank. So 24,000 and 24,000. So this is what we will do in this part. And when this part happen in here, you will debit tax payable 34,000, and this is still year 1. And You credit bank, you debit here. So when you close this account, you will see there is a difference. So the difference here, Dodger, the difference here, 480 will be your balance brought forward to next year. So when you balance brought forward to next year, year 2, sorry, this should be CF. When you balance brought forward to next year, you will start off with 480, which is related to last year. And you need to clear this thing in your balance sheet. Because this is in your tax payable, which is under your balance sheet. And this particular amount is your under provisions of income tax. You provide 23,000 as your expenses, but your actual payment is 24,000. Meaning to say, you are underestimate. So this underestimate will be your next year expenses. You are going to clean up in next year. So assuming this is provisions for 2020, sorry, year 1. And year 2, we will need to do the same procedure again. So this is year 2. If year 2, your tax estimate is 26,000, assuming you are going to do year 2 income tax expense account. So year 2 income tax expense account, year 2. So you are going to debit here tax payable 26,000, and you are going to credit here 26,000. So this is year 2 tax expense. And the issue arising in here, this particular year at this particular last year expenses or under provide, you will need to clear it in this year account. So we will adjust it to here. So as you can see, this 480, now I'm going to transfer it to income tax expense account. So I will transfer it now. So 480, I credit here, transfer to tax expense, and 480, I will transfer from the tax payable account. So this is called under provision. I will put a name, under provisions of last year tax. So under provisions of last year tax. So ultimately has been transferred to income tax expense. So this net, nothing. So you have cleared it off. And only then we can close the entire income tax expense account. So originally you only estimate 26,000. Because last year you underestimate, you have an extra 480 to be put in your SOPL. Then over this side, you will need to close it. And this minus this. So 26,000 is related to your next year. Then you're awaiting for the next tax payment. Something like that. So this is something like the concept of allowance for doubtful debts. And you can just follow the same method. So if we further drill into this income tax expense accounts, they actually have a fixed formats. The formats here we can summary into this part, whereby your tax payable, current year tax payable will increase your income tax. Any under provisions of last year tax will be put it over here, under provisions, and any over provisions of last year tax will be in here as a saving, because income tax expenses increase in debit, expenses reduce in credit. So this is the logic. And further to this, there are second part of IAS12 talking about deferred tax. So this deferred tax, if it is a deferred tax liability, it will increase your income tax expense in the debit side. If it is a deferred tax asset, it will be your reductions of income tax expense. or reduce in deferred tax liability also in here, or increase in deferred tax liability in here. So this is the summary. Then next things you are going to ask, what is deferred tax? Deferred tax is actually you are kind of acknowledge the future obligations that you claim more tax now, that you are going to pay more tax in the future, the difference in tax law and accounting principle, that obligations you are trying to bring back now, and you include it in current year income tax expense so that you won't understate your expenses. So let's look at the second part to understand what is deferred tax. So the second part, deferred taxations. So part B, deferred tax. So deferred tax, let's summarize it in here. So since we know that there is a difference, so these differences is actually arising from the difference in your accounting principle or your IFRS and your tax law. So since you are actually dealing with the different set of rules, so in accounting, we will follow our IFRS. In your income tax, we will follow the Income Tax Act. So in this case, there will be a difference in treatment. Like for example, depreciations, I calculated based on useful life. I just divide against it and calculate useful life based on useful life as per IAS 16 PPE. But in tax law, we normally following the tax depreciations, or we call it as capital allowance, and this is based on the percentage given by the Inland Revenue Board. And in these tax depreciations, right, normally you will have initial allowance plus annual allowance in the first year. So you will claim more in the first year. So different in tax law. Then the second one, fines is your expenses in accounting, but in tax law, fines never be deductible, or penalty never be deductible. Therefore, different in tax law and accounting principle again. For example, provisions of certain expenses is your expenses, but in your tax law, provisions allowable only when, or allowable in cash basis. So meaning to say, when you pay, then only I give you these deductions. If you didn't pay, you recognize the expenses now, but tax will assume still cannot deduct. So there is a difference in treatment again. So this is the general difference. And last, I can give you revenue, unearned revenue. Unearned revenue is your liability. You record it as a liability, not your income. Not your income. But in tax law, they will treat this revenue will be taxed on cash basis. So meaning to say, I don't care. I don't care, this is an unearned revenue for you. But in tax law, if let's say the revenue they are going to tax in cash basis, you will actually need to pay tax on that time when you receive the money. But in accounting, you are going to delay in recognize the revenue. So again, different in tax law treatment and accounting principle treatment. So collectively here, actually we can classify such difference into two broad categories. So these differences can be two types of differences. One is called temporally difference. One is called permanent difference. So as you can see from the words itself, you already know temporally difference means the difference that is last for temporarily, and one day you are going to resolve it. But permanent difference, the tax law and also the accounting principle, it won't resolve one day. In the future also won't resolve. So now, let's talk about temporally difference. So let me give you an example. If you have a car worth 30,000 and you are going to use it for 3 years, but your tax law say first year claim 20k tax depreciations. So let's look at that. Then subsequent year 10,000. So if under accounting and under your tax, what is the implications? And this is very important. Under year 1, your costs under your accounting definitely is 30,000. And then for your tax, also 30,000, qualifying capital expenditure. And you need to minus your depreciations by 10,000 because your useful life is 3 years. So divided by 3 is 10,000. Your tax first year need to minus 20,000. So can you see the difference in treatment resulted in your carrying value under your accounting left with 20,000, but your tax base, or we call it as residual value in tax base is 10,000. So there is a difference in here. Then if you go through the second year, okay, this is tax base, and this is your capital allowance, and this is your cost. So same things. So in here, minus 10,000, minus 10,000. So your carrying value and tax base, here is 10,000, your tax fully claimed. And finally, so this is year 1, this is year 2. Finally, year 3, you do the same things, depreciate, but for tax already nothing, claim, and your carrying value under accounting, nothing, and your tax also nothing. Can you see? This is the time whereby your variance is being resolved under accounting and also tax. So you have temporary difference for 2 years and finally become the same. So this is called temporary difference. So what is happening in here? This difference in your carrying value and tax is important because you are actually trying to tell us that in year 1, you are claiming higher capital allowance, resulted you pay lower tax, and in future you are going to pay higher tax. So we will call this difference as taxable temporary difference because you are enjoying the capital allowance, the benefit now, future you are going to suffer. So we are recognizing this liability now. We are trying to be prudent, and same things also this one. Therefore, such temporary difference that I mentioned in here can be can be classified into 2 types. So these 2 types is something that very important that form up the entire temporary difference. One is called taxable temporary difference. Another one is called deductible temporary difference. So taxable temporary difference means you are going to get to pay tax in future. It's your liability. And deductible temporary difference means you are going to get the deduction in future, pay lesser tax. So we can sum up. Taxable temporary difference means claim deductions now, or claim more deduction now, pay lesser tax now. Eventually, you need to pay higher tax in future. So you will need to have this liability, recognize it now. For deductible temporary difference, it will be the other way around. You claim lesser deduction now or no deduction now. You pay higher tax now, you suffer now, and you pay lower tax in future. So this is the difference. One is your liability, one is your asset. So ultimately, this difference, you will need to translate them into your tax value. So you will need to apply with the tax rate, example 24%, I times 24%. And this is so-called your deferred tax liability. So when you times the 24%, this is your deferred tax liability. So let me draw the chart in here. So when in this part, you recognize it, you know you have a temporary difference. So the next thing is you times with the tax rate, you will get deferred tax liability, and here is deferred tax asset. So deferred tax asset is actually your income or reduction of income tax. So if you were to ask me to do a double entry, we are going to debit income tax expense and credit deferred tax liability as your non-current liability in SOFP. But for deferred tax asset, you will debit deferred tax asset under non-current asset, and you are going to credit income tax expense because it's a saving. That's the reason why this one increase in income tax expense, this one saving in income tax expense is under your income tax account that I draw to all of you just now. Can you see? Deferred tax liability will in here, deferred tax expense asset will be in your income tax expense credit side. So this is the reason. And the last one will be your permanent difference. So when you decide the temporary difference, you need to ask yourself whether you are going to pay higher tax in future or pay lower tax in future. That will be help you to determine deferred tax liability and deferred tax asset. And the last will be the temporary difference. So temporary difference, I give you an example. Fines. So these fines, you are not going to get any deductions from tax perspective forever. So in this case, we will always treat permanent difference equals to no difference. Meaning to say, we will ignore this difference. If you tell me your accounting carrying value, your fines is 100 and 1000, this is your fines, and your difference is what you have in your carrying value minus your tax base equals to difference. But the things here is that since these things is something that is permanent difference, if you present like this, meaning to say you are telling people that in future you are going to get back the tax, okay, and some of this is the deduction, you are going to minus, okay, so it's a deductions. So in future you are going to claim back this 1000, but no, in future this fine cannot deduct. So we will just put an adjustment here, straight away equals to carrying value, make it no difference. So this is why we say permanent. So this is the logic. And a couple of example that we always see when we calculate the temporary difference is first, which is our PPE. So PPE, like the asset that we do just now, carrying value and your tax base. So normally PPE will have, okay, let me just format this cell. Let's say in your accounting, you have 10,000 carrying value. But normally in PPE, right, tax base will be slightly lower. The reason is because they claim more tax in terms of capital allowance. So the difference will be 3,000. We are trying to tell other people that in future we will get to pay 3,000 difference tax higher. And second, provisions of expenses. So provisions of expenses, normally we are going to deduct it, tax deductions, when in cash basis, okay, cash deduction in cash basis, meaning to say that if you recognize a provision as an expenses now, 7,000, but these tax deductions you are going to deduct when you pay. You accrued now, but you haven't paid. So in future, you are going to get these particular deductions. So in future, your difference must be 7,000. Therefore, tax base is 0. Or we can actually mention it like tax base, now we do nothing. So there is a difference, 7,000. And number 3, if there is an income receivable which you are going to tax on cash basis, income receivable you tax on cash basis. So you actually recognize 2,000 income receivable as an asset. Now you debit receivable, credit your income. But the thing is that tax won't make any adjustment now, tax won't tax on you now, and you in future when you receive the money, tax only will come and tax you. So in that case, you will have a difference 2,000 to be taxed in future. Therefore, tax base nothing. Or in now, you can expand it in now, tax do nothing, so 0. Therefore, there's a different 2,000. And number 4, for example, if it is an unearned revenue tax on cash basis. If unearned revenue tax on cash basis, you didn't recognize any carrying value, you didn't recognize any revenue now, and the tax already tax on you because you received the money already. So meaning to say, in future, you are not going to get paid tax because you suffer now. So there's a liability being recognized in here, 600 example. Okay, it's a liability, and your tax you are going to pay now. In future, you don't need to pay. So in future, you will be able to, when you recognize the revenue, you won't get paid. In future, you won't pay the tax. So there will be difference of 600 to be avoid the tax in future. You don't need to pay tax in future. So tax base, nothing. And last will be penalties that we mentioned just now. Since I tell you penalty is 40 ringgit, and in here, because this is a permanent difference, you cannot just leave it blank, because if you leave it blank, your difference will be 40. So permanent difference means no difference. Therefore, we will just put a 40 to make it, we will just put a 40 to make it 0. So this will be your differences. And you sum it up. If it is a negative, meaning to say this is a deductible temporary difference. So you will need to translate them into tax rate of 24%. This is your deferred tax asset. So your deferred tax asset, you are going to debit your deferred tax asset and credit your income tax expense. And the last part, when you are dealing with PPE, that is the revaluations portions. So this revaluation portion under IAS 16 revaluations model, you are going to debit your PPE increase in value, and you need to credit your OCI as revaluations surplus. You are not putting it in your SOPL. So in this circumstance, if the portion in here PPE, there are certain part is related to your revaluation model. So for example, if the revaluation surplus is 10,000, okay, and the tax rate, after you apply the tax rate of 24%, so such difference resulted in here 2004, you cannot, it's something that you are going to get taxed when you realize in future, because now it's unrealized. If in future realize, you are going to pay tax. So this is your deferred tax liability. You cannot debit income tax expense and credit your deferred tax liability straight away. You cannot do like that, because since in here you are actually record the income in OCI. This is in OCI, this is in SOPL. If you do like that, your earning in OCI, but your tax related to such earning in SOPL, there will be a mismatch. Therefore, this income tax expense should be offset against your OCI revaluations surplus in here. So instead of do like that, you will need to debit OCI credit deferred tax liability, and this is on the tax deferred tax on revaluations portions. That's all. Thank you so much.